Well, good evening, everyone. This is AJ Monty with the Market Guys. It is 8 p.m. Eastern Time, and we are ready to go with our open house Q&A session. You should be able to see the Market Guys website right now. It's kind of scrolling by. And for those of you who are brand new to the Market Guys, I'd like to suggest that you click on the video link there, the videos link, and bookmark this page. This is a library of very short videos that we call market shots, and on average the video length is anywhere between 4 and 5 minutes long. There are some exceptions to that rule. I think the 1% rule video is about 9 minutes, and the option video here is about 9 minutes. So we're going to continue to add videos to that page and give you that increased value in the content. So we are in a very interesting point in time here in the market, and I'm going to pull up a couple of charts. What I normally do is I go into, let me make sure that this is going right. We normally go into what I call the week in review, or I go over the markets in review. And in the last broadcast, this past weekend, I did not put out a weekly market report, but the week before that I did. And I pointed out a pattern that is forming here in what is known as the head and shoulders pattern. Now, if you go to the video page on the Market Guys page there is a head and shoulders top video. See that one right there? It would be a good idea to review that short video so you can get the full understanding of what I'm talking about with the Dow. The head and shoulders pattern is a very popular pattern that has been known to be one of the most accurate topping patterns in existence. And the way it looks is, this, by the way, is a weekly chart going back about 3 years. You can see here that the market came up, hit a resistance point right here, then it came down, then it went up again, hit another resistance point, came back down, and went up again for the third time. And just last week, we hit that resistance top and came back down with what is now showing as an inverted hammer. But the interesting thing about the head and shoulders pattern is that it basically outlines the places where there's not only resistance, but it marks what's called the neckline, which I'll draw here in a little bit, that gives us the defining moment, or the defining price of when the market completely drops. So here, this high point on the left is going to be a shoulder. That's what that is defined as. In a head and shoulders pattern, the next peak is usually higher than the previous peak, which it is here, and that would be the head. Now, in a completely perfect scenario, textbook example of the head and shoulders pattern, the right shoulder, when it's formed, is usually lower than the head. In this case, the weekly chart is showing a long shadow. So the opening price, I'm still going to look at that as a lower shoulder because the high was a failed high. It came back down later in the week, and I'm going to define this as the right shoulder. But the neckline is the most critical part of this whole pattern. The neckline is when you take the two troughs, or the lows, you take that low, and you simply connect a line to those two. That is called the neckline. And what I'm expecting is the market to drop not just to the neckline, but eventually through the neckline and below it. And when that happens, watch out below. That is the major trigger that will cause a lot of the sellers to get in. It will also cause a lot of institutions to get out of positions, and you'll see a dramatic increase in the volume once it drops down below this neckline. That neckline, excuse me, that neckline is right around 15,000 for the Dow. So we're just about 370 points away from the neckline. You can see here today the diamonds closed 153.71, which for the Dow would be 15,371, because the diamonds is 1/100th of the Dow. And we are on watch right now. So for me to get aggressive in any long positions when I start to see the right shoulder forming, it doesn't make sense for me to push long positions at this point, because it's a dangerous place to be. I encourage people to move into cash or get out, take profits in stocks that have done well for them, and wait in cash until we see this pattern complete. Now, a couple of other things. If I look at the S&P, which is with the spiders here, this is not a textbook head and shoulders pattern, but it definitely is a topping pattern here with a double top being reached right here. This long shadow above last week's candle was on high volume. Do you see this? High volume usually identifies the pivot points. A high volume could be on a high, it could also be on a low, but it's usually when the buyers and sellers are battling it out. You can see back here, although this was a low pivot point, the volumes were increasing and then it peaked out. So we are seeing clear signals on the technical charts that are telling us caution flag is out, watch out for long positions, and most likely we're going to start seeing some selling activity. On a more broad-based index, which I look at as the Russell 2000, I can look at this at a weekly chart. You can see this is an extreme upward move, but what really caught my attention with the Russell 2000 is when you turn this to a monthly chart. This, let me get rid of some of this lines here. So this line here. This is an extreme upward trend that is beyond a 45-degree angle. And when you have upward trends that are greater than 45 degrees, the longer they last, the harder the pullback will be. And we saw this back here, if you notice back in, what month was that? That was May of 2011. We saw an accelerated angle from an already steep angle where this starts to fan out, and this is close to a 70-degree angle here. You can see how dramatic the sell-off was after that trend broke down. And again, that doesn't look like much on the chart, but percentage-wise, this causes a lot of stress for any investor who might be long the market. And finally, my report wouldn't be complete unless I were to look at the VIX. The volatility index is a contrarian indicator to the S&P, and looking at this on a monthly chart, you're going to see that we had a bullish engulfing pattern last month. A bullish engulfing pattern on the VIX is not something that you should ignore, because if you look back in history, every single bullish engulfing pattern that has formed over a 10-year period on the monthly chart, every single time a bullish engulfing pattern occurred, the market, the VIX eventually went higher. You can see here's a bullish engulfing pattern, it went higher. Here's a bullish engulfing pattern, went higher. Here's one again. You look here, there's another one, VIX went vertical almost there. And again, we have a series of bullish engulfing patterns forming right at this base, here and now here. So my expectation for the VIX is that we're probably going to do this. Now that's not out of the realm of possibilities here, because if you look back, you can see that the angle at which the VIX has gone up in the past has been quite steep. So if you look at what I'm doing here, this one was quite steep. This is 2008. But you can see that the angle at which the VIX starts to go up, this is very much a possibility where the VIX could go from 14 to 35 or 40. And we're not talking over years and years of trading. This could be in 3 or even 4 months of activity to follow. Again, this stretch right here was 1, 2, 3, 4 extreme candles to the upside. Here again was 4, 1, 2, 3, 4. It went up. back here, 1, 2, 3, 4. See, in a 4-month period, that could absolutely happen. Another thing is the cycle or the rhythm by which these spikes in the VIX occur. And I want to start off, before we get into the stock analysis part of our presentation here, which is the rapid fire stock analysis, I want to bring your attention to a website that I've used in the past. I have one of several of our clients that have been subscribers to the Oracles already know this, but years ago when I was trading on the trading floor, there was a fellow by the name of Stan Ehrlich who developed the Ehrlich Cycle Finder. And if I go to the internet here, I'll give you a website that you could, oh, that's not it. Where did it go? It was, oh, here it is. If you go to stockcharts.com, go to stockcharts.com, this was developed by a friend of mine, John Murphy, who is one of the world's leading market technicians, written several books as an author and as a commentator on CNBC. He is one of the world's authorities, and he created this. And interestingly enough, they put a cycle finder into the software. And I'd like to show you where that is so you can find it for yourself. If you go to stockcharts.com and just go to the front page, there's a little drop-down menu up here that says Create a Chart. Leave it on Sharp Chart. Don't change any of that, and just put in a stock symbol. You could even do the VIX. Okay. There's the VIX, and I'm not going to waste time removing all these other indicators here. I normally don't put as much information as they have on the default, but you could do whatever you want. I like to keep my charts very clean. But to give you the steps, and again, this is being recorded, so you don't have to take such stringent notes here. Bill Shanley, my partner, is going to post this to our members, and you'll be able to get this information quite easily. So just listen carefully. You can go back to the recorded video later to get all the details. You go to stockcharts.com, type in a stock symbol. In this case, it's the VIX. And right on the bottom here, see where I'm circling my cursor? It says Annotate. When you click on Annotate, another chart is going to come up. It'll load the image. And it's a pretty clean looking chart. No doubt that it's a candle chart. And if you look at the top, there's a series of icons up here. And almost to the middle, or just right of the middle, see where my cursor changes to where it says Cycle Lines Tool? Click on that. And what will happen is your arrow or cursor will change to a crosshair. See that? Now, when Stan Ehrlich created the Cycle Finder, it was a device that was laid over charts that we would actually write by hand, because in 1982 and 1985, when I was trading gold and silver, we didn't have computers. I mean, Microsoft wasn't out yet, and IBM was just putting out some computers, and I bought an IBM Model 50, I remember. It had a whopping 50 megs of hard drive. My cell phone blows that away. And I didn't even have the ability to download charts because the internet wasn't even created yet. So, this was a real pioneering stage where Stan Ehrlich would bring out this device, and we would tape our charts together, and we would roll them out. They were all scrolled out, and we would roll them out on these long tables. And as I told Andrea last week, the device looked like one of those child gates. You ever see those child gates that it looks like an accordion, and you stretch it through the threshold of the door, and it keeps the kids from falling down the steps? Well, it looked like that, and it would stretch out about 3 to 4 feet wide, and the bottom of this accordion device would have an area where you could put a pencil or at least a marker, and it would stretch it out. And this electronic version of that works very nicely. Watch, I'll show you. When you're measuring a cycle, for the most part, you measure it from trough to trough, or low to low. But you could also incorporate some of the highs in there if you see fit and match those up. So watch what I'm doing. Taking my cursor, and I'm going to this date right here, which is right on the 14th of April, and I'm going to click my mouse, and I'm going to hold my mouse down. And as I hold my mouse down and drag it to the right, look what happens. See the accordion? How this, when I stretch it out, the distance between the lines widens. When I go to the left, the distance between the lines narrow. And what I'm looking to do, and this is where you need a little bit of artistic license, you take the cursor and you try to match up as many of these lows that you possibly can. Okay? And let me just drop it right, let me see, right there. Okay, I'm going to drop it right there. Now, excuse me, look at the blue lines. These are separated in exact timeline, so that there's an exact number of days now that separates these lines, and you can measure that. See, if I put my cursor on the first line, you could see that that's April 12th that the line falls on. See the bottom of the chart? Look down at the bottom corner. You'll see it says April 12th. Well, remember that date, because now I'm going to go over to the line to the right, and that is May 14th. So it's almost exactly a month that separates these blue lines. And if I did the same thing between May 14th and, there you go, June 17th, so it's roughly 34 days that separates them. You can see how nicely the cycle has been identified. Now again, this is the VIX. This is the VIX. If I have a low here and the VIX goes up, what is that going to mean for the S&P 500? Well, remember, the VIX is a contrarian indicator. So if the VIX is going up on that in that time cycle, most likely the S&P is going to drop. So here's a low, perfectly. The VIX went up from that blue bar. Here, the VIX went up from that blue bar. Here, again, it pulled back, and then it found the bottom, very close to the hammer pattern there, and then the VIX went up. Here, again, on the 22nd of July, the VIX went up from that point. Here, again, we're off by maybe a day, where on August 22nd, the line fell, but August 23rd, the VIX went up. And where does that leave us now? Well, let's measure that. If August 22nd is the last time that the market went up, and these lines are separated by roughly 34 days, then I'm guessing that September 26th, most likely, September 26th, is the day that the VIX is going to start to go up. So, you know, that's September 26th. Here it is, September 23rd. 3 days until that next blue line shows up on this cycle finder. Now, I'd like for you to take this tool and experiment with it. Does anyone have a stock they want to throw in there so I could show you how well this works with regard to finding cycles? Just if so, just type in the stock symbol. Okay, Marty has cat. Let's put in cat. So I'm going to get rid of this, and again I'll go through the charts here with you. So I'm going to put in CAT, hit enter. Then I'm going to go and move. I have to move this out for a second. Okay. Then I'm going to click on annotate. Click on annotate. A separate chart's going to come up. Okay. Now let's go through the exercise once again. Here's my cycle line. And I'm going to do this two ways. I'm going to measure the low. Here's a very well-defined low. Here's one. I'm going to click to the right, and I'm going to try to click and find as many lows as I possibly can. Okay, now, let's look at this. Okay, Marty, pay close attention. I don't know what your position is, but here's a low. On April 19th, we've identified a low, stock went up. Here is a low. Again, May 15th. Market went up. Here's a low. On June 11th, the stock went up. Here's another low. On July 8th, stock went up. This was not a low. It happened to be a high, but you know what? We're only 3 days away from a low here. Not so bad, pretty close. And once again, here's a low. Today, Caterpillar came down, but that means right around tomorrow, we should see, according to the cycle finder, if the sequence continues over the next 2 or 3 days, we could see Caterpillar go up. And if you're within 2 or 3 days, that's still pretty close to the cycle finder. So there's your cycle. Now, you can also use this on a weekly chart. And it's going to look a little bit differently when you do that, because you can click the period from daily to weekly. See that? Click update and annotate from there. Now, if you're interested in finding highs, and this is a weekly chart, okay, this is a weekly chart, let's do the same thing, but let's measure the highs. Let's see if we can find a cycle in the highs. Here's the highest of the highs, and I'm going to go and see if we can find a cycle here. There we go. All right. Now, this is a weekly chart. This would be for maybe an investor instead of a trader, and this is going back about 2.5, almost 3 years. And we have a high here. The next line identified a high. The next line identified a high. If you're interested in finding out where the next high is going to be, how do you do that? How would you do that? Well, you measure the distance in time between the two lines, go to the last line, add those number of weeks or days to that line, and that will most likely give you the next high that would be forecasted based on the cycle. Now, I'm not going to spend too much time on this because this it's a great tool. It's not 100%, nothing is, but the reason I want people to start focusing on cycles is because if you start looking at these, especially long term, if I go and look at the Dow or the S&P, let's put in diamonds here, and I'm going to go to a weekly chart on the diamonds. Again, looking at the highs, let's go try to find the cycle on these highs. Let's go here. Let's see if I can find. There we go. Here's another one. High, high, pretty close to a high. You're only a week or two away from that high. Again, you could measure the highs going out that way. If you want to do it again, you can delete these and do it all over again. If you want to do more frequent highs, you can do this, do this. Let's see if I can find that way. And that's pretty close too. So here's a high, there's a high, there's a high, there's a high, there's a high, not so much a high, there's a low, it's pretty close to a high, and there's pretty close to a high. So you can adjust the frequency to whatever cycle you want, but again, you can see that it's a fairly regular cycle, and there's a reason for this, and some people don't really understand how something like this could work so well. You don't hear the analysts talking too much about cycles. It's actually a very overlooked phenomenon in the market that people ignore, but a lot of it's actually based on weather patterns, behavior patterns, seasonal patterns, behavior patterns, and it's one of the reasons why we have so much fun trading, Hershey stock. If you're an Oracle subscriber, a lot of times you'll see me come out with an alert at the end of December or beginning of January, and I tell people buy HSY, buy Hershey stock. Why? Because historically, for the past 20 years, if you have done so every single year for 20 years, you would have made money. Why? Because of a little thing called Valentine's Day. And it's almost become a joke in the market that people will just go in for fun and buy Hershey and turn around and sell it. The fundamentalists say, well, that's just the sheer action of people buying simultaneously. I don't care what you call it. Market goes up when people buy it. If they're buying it seasonally and selling it pretty much at the same time, it's going to go up and down. And if you know that every year for 20 years, why not go make money from it? You don't have to have an explanation fundamentally why that happens. Technically, it works. And again, I encourage people to look at the cycles. Okay. If you have any questions about that, go ahead, punch them in. I am taking questions as well. Let me see. Joseph says, would you say that you look for support and resistance? Yeah, absolutely. The cycles can be marked as support as well as resistance. And you could also try to find the highs and lows with the cycle. You don't have to just focus on the highs alone. Again, let's see. Joe Bueller says AFOP. Let me type AFOP in there. See if that works. AFOP. I don't know what stock that is actually. Alliance Fiber Optic Products. Okay. Well, this is a weekly chart. Let's see if I go to a daily chart on this one. This has been in an upward trend for a while. See if we can find the highs and lows on this one. Okay, I'm going to help Joe out, and I'm going to once again click on annotate. It'll open up another image, and let's see if I can find highs and lows. So here I'm going to click on a very well defined low. Oh, let me get the click on the lines first. Cycle lines 2. Click on that low. Let's see if I can find. There's a low. There's a high. Here, this is a good example of that. Here's a low, pretty close to a low. There's a high, close. Well, that was in mid trend. There's a low. There's a high. Mid trend again. There's a low. There's a high. Okay, so if you're looking to use the cycle line tool as a way to calculate or time the pivot points, whether it be a high and or a low, you could do the same thing. So again, going back, I'll give you an assignment or a homework assignment here. It's okay. Repetition and practice will make you a more efficient trader. Go ahead and try this out with your favorite stocks. And what I'll try to do is I'll try to incorporate some of that in the Oracle alerts. For those of you who are Oracle subscribers, I'll put that in there. By the way, if you're not an Oracle subscriber, I don't know how you would have gotten on this web seminar, but if for some reason you're not an Oracle subscriber, I would encourage you to go to the Market Guys website and look into that, because I put out a weekly trade alert to our subscribers, and I do exactly what I'm doing with you now. I do this all day long. You know, it doesn't take me long to write the report. This is what it looks like. That's the options oracle, and right behind that is the equity oracle. It doesn't take me much to write it. It takes me a little bit more time to do the video. For those of you who are subscribers, I put time into the video, but the most time that's spent is actually doing the research, because I have to check the stock out, not just technically, but I do check it fundamentally. I check for news, I check for earnings, I check all those things. And so it does take me hours and hours to do those alerts, but when you get it delivered to your mailbox, it's right there for you. And most of the time I put it out on a Friday. For those of you who may have gotten an alert last week, I put one out a little bit midweek, because there was a trade opportunity there that we needed to take care of. But I am very mindful of the fact that a lot of people are new to trading. So what I try to do is put it out on a Friday, so that you have the whole weekend to think about it, learn about it, and then trade it on Monday for the following week. All right. One of the trade alerts that went out was in GERN. I don't know if any of you have watched that, or if any of you missed that trade. This could actually be painful for those who didn't trade it. But this is the actual chart. GERN, we bought it right here. I'll zoom in for you. This is the actual triangle pattern that I identified on the alert, and we bought it as it was breaking out of this triangle. It was right around, I think we bought that at $1.54, or it was definitely under $1.60, and the stock in a matter of just a couple of weeks has more than doubled since then. If you're still holding on to this, congratulations, but I would watch this one tomorrow. If you still have it, I would watch it, because if you have a drop in volume tomorrow, it would be your time to sell it. I mean, let's face it, if the stock has gone up 100% in 2 weeks, you really should think about taking a profit if you're not, because it could easily, very easily, drop right back down to 170 from here. Very, very easily do that. So that was just one of our stock picks, and I hope those of you who traded it made a lot of money. Okay, now is our time, 8:30 on the nose. Now is our time to go over the rapid fire stock analysis. So if you go ahead and there's a comment by Brian. I thought you don't buy stocks under $5 GRN. I did identify that in the alert as to why I am buying that, and the reason is this one still had a very high institutional ownership, and this stock has a history of volatility, and that was one of the reasons. The other reason, Brian, is for the option traders, what we did is we sold puts, or we sold a put spread in Apple, and we collected money when we did that. And once in a while, I will contribute to the free stock accumulation plan. And what we do, it's mainly for the option traders that will buy under $5 stocks, because what we do is we sell options to collect money. Then we take that money and we buy stocks that have potential in doubling or tripling or even more. And we tuck those away. We just accumulate that, and after the option trade is over with, there's zero risk to the option trader at that point. For those of you who did sell the Apple put spread, you should have made money on that, and now you've wound up with free stock in GERN. So Brian, that's the main reason why I did that. It's not a common practice, and I certainly don't like playing penny stocks, but this is one that's been around for a while, and that had a history that really allowed me to get into this one. And you can see that it wasn't too long ago that was trading around $9, $10 a share, and it still has good institutional ownership. So too late to buy it now, but when it gets back down to a level of support, that's one that you would keep on your watch list. So thanks for that comment, Brian. I appreciate that. Okay, Steven says UUP is considering going long. Now UUP is it's a U.S. dollar index, and it's a bullish fund. So if you're bullish on the dollar, this is one that you would consider. Now I'm going to remove some of my lines because this is one that we have traded before. And again, Stephen, I'm glad that you're telling me you think about going long, because that is actually not such a bad idea for UUP, and let me show you why. There is an area of support. Let me change my lines from a trend line to a price line. There's an area of support right around here. Now, again, those of you who are brand new to drawing support lines, look what I did. You're probably saying, well, AJ, you went right through that low. Well, yeah, because you're never going to find lows that match perfectly, all in one line. So what you have to do is you have to let your eyes scan where the lows are, including the most recent low, and try to connect as many of those dots as you possibly can. This one happened to violate that line, but it did so with a hammer pattern, which happened to be very bullish. So this support level for UUP, right around 2161, is very well-defined support. So, Stephen, if you're thinking about buying, number one, the first thing that's working in your favor is the fact that it's bouncing off of support. Okay. Number two, there are a series of gaps above the market. Now, the dollar is, you have to understand something. The dollar, when it trades, like many other currencies, trades mainly on the technicals. And I don't mean to insult any of the fundamentalists that are on the call right now, but let's face it, if you try to analyze any currency, you have to almost be part of the FOMC, because you have to be a top economist to even figure out what's going to be affecting the dollar or global currency. So, by the time you do all your analysis on economic changes and supply and demand and money supplies and interest rates, by the time you figure all that out, the trade's gone. So most people who are trading currencies are using the charts to determine where their entry and exit points are. So we are bouncing off the support level, and we came very close. Stephen, I don't know if you saw this. We came very close. In fact, it may have even been a bullish engulfing pattern today. Let's see. Bullish engulfing? Yeah, it did. Okay, so yesterday, or I should say Friday, the UUP opened at 2170. So if we closed higher than 2170 today, that's a bullish engulfing pattern, and it did. It closed. Oh, it closed at 2170. So it does engulf the previous day. So there's a bullish engulfing pattern for you right here. So that's number 2. Bouncing off support, bullish engulfing pattern, 2 positive things. The other thing is that there's a gap above the market right there. See that? And there's another gap above the market, I believe. Yeah, here it is, back here. So there you go. Here's a gap, here's a gap. Currencies, especially the US dollar, does not like to leave open gaps. Does not like to. In fact, if you go back in time, you'll see that 100% of all gaps that have formed in the dollar have been filled. See, here's a gap that gapped up. It filled. When it filled, it reversed. Here's a gap right here. It eventually filled here. There's all kinds of gaps. Go back and look. Here's a gap. It gapped up. It eventually filled here. So if you're thinking about buying UUP on the long side, I would put my price targets here and or here. Now, the other thing is, you're not going to hit a home run and make a killing on UUP, because you could see that although this looks like a big move in the charts, it's only a $1 move for it to go from 2170 to 2270. That would only be a $1 move here. So it trades in small increments on the price scale. So if you are trading this, most likely you're going to have to trade more shares to get in and out of this particular trade. I mean, because if you buy at 2170 and the gap fills at 22, you're only making 30 cents. You see? So it is very accurate when it trades according to the charts, but you just got to be really careful, because it's not like a Google where it's going to move $15 in one day. So you have to be patient with that. Okay, so that's my spin on that for you, Stephen. Hopefully that helps you out. Paul Farley, Baidu. Paul, what's your position? What I'm going to do, if you could, I'm just going to go with the folks that tell me what their positions are. Paul, I'll wait for you to tell me what your position is so you could. Okay, Paul wants to do verticals on that. Okay, BIDU. All right. Now, Baidu is one that we have a credit call spread in. It's not cooperating as much as I thought it would. And today, unfortunately, for those who have the credit call spread, we had a bullish engulfing pattern today. So if it closes higher, we may have to close that position. I have to watch on that. But the good news is the bearish position that we have on has gaps below the market. There's a gap here. There's a gap here. And although it's a bullish engulfing pattern, the volume is lower today. So we have to watch this one. If you look on the monthly chart for Baidu, this one is right at a resistance point right here. See that resistance point? So we have a series of green candles on the monthly chart, but what's happening is the volume is starting to drop on the monthly chart at resistance. So long term, I am very bearish on Baidu, and there's lots of different things that we can do in Baidu to make some money. So right now, that's what you have to do. You have to be defensive with that one, Paul. And I'll keep everyone posted on the spreads as we go from expiration week to expiration week. Okay, Bob Beers, SDS. I have several open October calls at 35 and 36. Should I go longer to January? Well, Bob, first of all, I never recommend people buy front month calls. You're almost guaranteed they'll lose money on that. It's unfortunate. If you've read my book, you'll understand that most people lose money because they buy cheap options in the front month. So be careful. I always recommend, whether you're a short-term strategy or a long-term strategy, that you go further out in time, because there's less of a chance of your suffering time decay. Now, for those who are not option traders, bear with me. Time decay is actually the enemy for those who buy options. And the front-month options are loaded with time decay. So let's look at SDS. Although I agree with your position, I do think that the by the way, SDS is an ultra short for the S&P. When the markets drop, the S&P, when the markets drop, SDS goes up, and it's leveraged. So let's look at that. I'll remove some of my lines here. You do have a pivot point. That's good. You have a gap above the market here. You have a gap above the market here. And you have a very small gap above the market up here. So ultimately, I do think SDS is going to go up because I do believe the S&P, the Dow, and a lot of the other indices are going to go down. But you not only bought the front month, but you bought out of the money options in the 36 calls. So those are just time value. There's no intrinsic value there whatsoever. So hopefully that helped you out. Okay, Jan, welcome, Jan. AGNC is what Jan is looking at, AGNC. By the way, folks, as I'm analyzing these stocks, hopefully you're getting some ideas about what to trade. You know, one of the biggest advantages of participating in the open house call that we do once a month is that you could be totally void of any, stock ideas, but by tuning in, you can obviously see that people are suggesting that I analyze their stocks. All of a sudden, Jan gives us a stock here that actually looks pretty good, and you might want to add that to your, to your watch list. Now, Jan, I don't know what the fundamentals are on this. I would like to check that out to at least see what institutional holdings are. But a good sign for this stock is that today the Dow was down, but this stock is up. And folks, if you're looking to find strong stocks, some of the best days to look for those are when the Dow is down. Because if a stock is going up when the Dow is going down, that's a sign of resilience. And even in a down market, even when the major indices are going down, there's always going to be one stock or two stocks or maybe even many more stocks going up that are contrarian to the Dow. So here we have American Capital Agency Corp. It's trading for around 2371. Analyzing this, let me back up. I'll do some 3D charting. Look at the weekly chart. Here's a stock that has taken a real beating earlier this year. It was trading around 32, and it dropped. Wow! It took a 30% drop in price in a series of a month and a half. It got pounded in this series of red candles here. Then all of a sudden, the pivot point started to form. So you have a support level right there, right at this low. Let me go back a little bit further, see if there's any of the support but that. Interestingly enough, look at that. You got a roll reversal support level here. So right over 20, right around $20.20, you have a support level. So that's good. Now let's go to the weekly chart again. Analyze a little bit further. Okay, you have an upward trend going. Let's go now to the daily chart and see what the daily charts are looking at. Now, Jen, you're looking to get in for a few points. I would concur with your idea there for a couple of reasons. It's above the 20-period moving average. That's good. It looks like today there's a bullish engulfing pattern. Yes, that is. That is the case. Long green candle engulfing or eclipsing the previous red candle is bullish. Now, if you want to take a short-term position but keep your stop a little bit closer than having to put it all the way down below $20, I would use this high as the stop loss point. So here's an area of resistance that was broken that is now turning into support. You can see that this roll reversal line, the red line, also converges onto the 20-period moving average, which is around 23. So I would suggest that if you do buy this stock, let it be a green candle tomorrow before you buy it. And number two, put your stop somewhere below the red line, and preferably below the 20-period moving average. So I would put my stop right around there, right around 22.90 or just below 22.90. Give the stock a little bit room to breathe there. And it's roughly an 80-cent per share risk per share, so your stop loss would be about 80% lower than where you buy it, 80 cents lower than where you buy it. And if you have the stock go against you, Jan, stick to the risk management discipline. Don't move your stop. because this stock could, if it breaks down below the 20-period moving average, it could wind up down here around 20 again on that support level. Okay, so be real careful with that one. All right, Dana Wells looking at POT. Let's take a look at that. Potash, this one that we've had before. This one looks real good. Let me get rid of some of my lines because these are the lines that were left from last report. Potash obviously has a gap that needs to be filled up here around 36. I don't see any green candles today, but I do see a triangle pattern. Let me show you what I'm talking about there. I take those highs and connect them, and you'll see they come down to lower highs and higher lows. There's your triangle pattern. So this stock is at the apex of this triangle here, and if you're thinking about buying it, then I would wait for it to close above the red line before I buy it. Because in a triangle pattern, if it breaks over the top line, it'll most likely run higher. But if it breaks down below the red line, it could definitely go lower, and there's still a gap below the market. So this is a tough one because the stock is caught between two gaps, and it's right at the point there at the triangle. So this would be a contingent buy only above that triangle. So be really careful about that one. All right, let's see. Ovid is saying EEM. Let's take a look at that one, looking from long perspective, EEM. Haven't heard about this one. This is the iShares MSCI Emerging Markets. That's interesting. This one doesn't look very bullish, and let me tell you why. I would probably pull away from a buy idea on this one. Ovid. This is a stock that is at a. Let me go to my price level. This stock is fairly close to a resistance point here, here, and here. The stock has gone vertical already, so it looks like you may have missed that vertical move over the past few weeks, and the volume is dropping. So let's review that for a second. If the stock is going up, obviously the buyers are controlling the stock, but the volume tells us the level of excitement behind the buy move. So if the stock is going up and the volume continues to go higher, that's very bullish. But what's happened is the stock has gone up, and you can see that the volume is successively moving lower. So that tells us that the buyers are losing that momentum they once had. So that's a negative. So the first negative is that it's approaching resistance. Second negative is that it's going up on lower volume. The third negative is the divergence between the stock price and the moving average. If you are measuring this, and everyone should get in the habit of doing that, you should see that stocks don't like to stay very far above or below the moving averages. They tend to want to hug the moving average fairly closely. So when a stock moves that far above the moving average, it wants to be drawn back to it. So that could be a 5% move lower before we get a bounce. And the other thing is you have a gap, a small gap, but you have a small gap below the market right around $40. So my guess is that the stock is going to pull back to that moving average here, fill the gap before going higher. So if you think about buying this, I would put a price alert right around $40.30. And then once the alert goes off, keep it on your watch list and wait to see if it does just this. If it bounces, great, because if it bounces, you could buy the stock and then put your stop right below the support level, and then you can move on from there. All right. One other thing, Justin, I'll get to yours. I'll get to yours here in a moment with UBNT. Please, if you could tell me what your position is, what you're looking to do. If you're looking to buy it, sell it, trade options on it, whatever it may be, and then I'll get to that. One other thing I want to mention to you is we have a Facebook page on the Market Guys. the link. Uh-oh. I know my partner works on the website all the time. Hold on. Let me go to the home page here. I thought there's a Facebook. Oh, no, it's not there. You could send me a text and let me know where the Facebook link is. I thought it was on the front page. It should have been there. We have a Market Guys Facebook page, and I do put out the alerts to the subscribers. So in other words, when the alert is going out, I will send a post on Facebook to let everyone know. And if you're getting alerts to your smartphone from Facebook, then that's a great way to know that the alert is in your mailbox. The other thing is, from time to time, I will post comments just on the general market condition, not on specific stocks. Obviously, that's for our subscribers. But on specific stocks, that's the trade alerts. But on general market commentary, I will put out information. And I also put out links to news items that I think are relative to what we're doing in the market. You know, when the Fed comes out with some information, or if there's something economically related, then and I think it's newsworthy, then I'll put it on the Facebook page. Okay, let's go to UBNT for Justin, and he is looking to buy that one. UBNT. Oh, that's interesting. This is a daily chart with a very significant hammer pattern there. This is a tough one, Justin, because here's a stock that's down below the 20-period moving average. Even though that's a hammer, the volume is still going higher. You see? The volume is still going higher on that negative candle. So that tells me the sellers are still in force. And we have a gap below the market. If you're going to buy a stock, you should try to find one that's bouncing off support, has a gap above the market, and is overextended to the downside, maybe from the moving average. This isn't the greatest candidate for a buy, although the only thing I see going for it is a hammer pattern. But that gap is always going to be in your face. If this thing starts going lower, and it could go from 30 to 22 just to fill the gap, and now where is that going to put you? That puts you in the poorhouse. So it doesn't feel good. It doesn't look like a screaming buy to me. But if you do decide to buy it, I would keep a really close stop, and I would put my stop somewhere right below that low, right below 28, and I wouldn't even hesitate to get out if it breaks down below that. Okay, Tom is long BNS. Let's take a look. He's long at 55. Let's take a look at this one, see if we get a trade candidate. Well, Tom, you're long at 55. You're up almost $3 on that one. Listen, you can't lose money taking profits. You really can't. And if I look at this, I'm analyzing this. Let me get rid of some of the lines here. Let's go back, have some fun with this. Look at the weekly chart. Now, Tom, if you could, I'm going to put you on the spot. Okay, I'm going to ask you questions specifically, and then you type in the answer. Okay, what you think that is. Now looking at this weekly chart, where would you say would be the best place for me to draw my resistance line? Where would I do that? Okay, I'll wait for you to put in an answer and see if you could help me out with that. Let's see. And I know there's a little bit of a delay in the Q&A box there. And Tom, you don't want to answer that. Okay, 59 to 60. That's exactly right. Right around here is going to be my resistance point. Why? Because there's resistance here, resistance here, resistance here, and it's trading just under 58. So we're only $1 or $2 away from resistance. Okay, Tom, here we go. What is the volume doing right now? As the stock is going up, what do you see the volume doing? Is it going up or going down? Okay, well, here it is. It is going down. See? Look at the time that the stock is going up. See that? And you're absolutely right, Tom. You did answer that correctly. The volume is going down. So what does that tell us about the upward move? What does that tell us about the buyers? Are they excited, or are they becoming less excited as the stock approaches resistance? See, this is the this is the simplest way to analyze stocks. Yeah, we could sit here and talk about the Fibonacci numbers and the Elliott wave theory and stochastics and relative strength index and Bollinger Bands. We could talk about that, but if you develop a skill that'll help you read charts just by looking at volume as compared to moving averages or support and resistance, and you use your volume to confirm that, you're putting so much in your favor as far as the odds in your favor, and you don't want to ignore that. So if you own the stock at 55 and the signals are starting to turn negative, why not just take your profit? Okay, because that's the weekly chart. Because if I zoom into the daily chart now, what else do we have? Well, we have a gap below the market here. We have another gap below the market here. And the way this stock looks, this stock could easily get back down to 54 and fill that gap. And if you take your profit, you're in great shape because now you created buying power for yourself. And if the stock gets back down to 53, 54 and it starts bouncing, guess what? You get back in it and you start trading it. So that's the best information I can give you is learn how to read the charts in its simplest form by looking at price and volume, and always remembering to compare price where it is to a major support and resistance area. You know, if you've had a chance to read my book, The Market Guys 5 Points for Trading Success, I try to translate support and resistance into economic terms that everyone can understand. You see, again, going back to, let's see if I can find one for Hans. I'll look at MU while I'm explaining this to you. Here is, excuse me, Micron Technology. Here's a stock that has gone up dramatically. Okay, Hans, I don't know what your position is or what you're thinking about, but this stock, just by looking at the sheer angle of where it's been, it is in an upward trend. It has been an upward trend for the past year. And then I look at the weekly chart, and chances are it's been an upward trend there. Yes, absolutely. But look at the angle at which MU has been going up. Look at the angle in the past. See, here's an angle. Here's an angle of an upward move. And if you look, this is one of the steepest angles it's had in 5 years. It's also one of the longest up legs it's had in 5 years. Excuse me, in 3 years. So if you own this stock, I'm not saying sell it right now, but you definitely want to be protecting this with stop loss orders fairly close to where the market is. Okay? Now, when I go into the daily chart, you could also see, remember this red line now represents that former line that I looked on the weekly chart. You can see the distance at where it is from the moving average. See how far away it is? Look in the past. In the past year, this is the furthest it's moved away from the moving average. What does that mean? Well, the volume is dropping. Okay, it means it's getting tired. The definition of the condition of the stock would be one that is overextended, overbought, or overvalued. Those are all terms that would be synonymous to one another in describing the stock. So, again, if you want to be a good risk manager, if you own the stock already, I would probably put a stop somewhere below 1690, and if it drops back down, get out. Don't worry, because there's gaps below the market. The way Micron has been trading, chances are it's going to find an area of support and then bounce off of it eventually. All right, so hopefully that's helped you out. Yeah, I'm looking at the clock. I again can't believe an hour has passed already, but I am going to change the way we're moving forward in the weekly or the monthly open houses. What I want to try to do is give you more information that will help you become more market savvy, and then still continue to do the rapid fire stock analysis so you get your stock picks and you can build your watch list. But I also want people to get enough experience in getting the feel for the market and learning how to look at price as compared to moving averages and support and resistance along with volume is going to be the best way for you to do that. So if you are not already a subscriber to the Market Guys Trade Alert service, go right ahead and try it out. It's very inexpensive. If you're not a mentor of the Market Guys, then send me an email. We could talk about that. there are certain requirements that you have to meet before I could coach you. One of which is you have to have at least $50,000 in your account, otherwise it wouldn't be worth your time or money. Because we want to make sure that you're trading more than one share of stock. So have a great evening. It's 9 o'clock right at the top of the hour, and I look forward to the next time we get together. Good night.